Hey everyone, welcome back to Fiscal Voyage. I'm Felix, and today's video we're going to talk a recent trade or purchase I did long term. The new position, and the company is Elevance Health Inc. ELV. Right now it's going about $4.96 and 96 cents. I actually had a pretty big day today after yesterday drop in share price. But we go to my interactive broker. You can see LV 2 shares at $4.94 at 17 cents. So I am up about 2% or so, or percent, close to 2% in this investment. Around $988, and I only bought 2 shares because I wanted to get my foot in the door in this position, and I'll show you why here in FastGraph. First off, this is what you want to see in FastGraph. When you use FastGraph or invest in companies, you want companies' earnings to continue to grow. This company has been growing earnings for the past 20 years at a compound rate of 13.3%, and you can see year in and year out, earnings been growing consistently. The only down year was in 2008, which basically almost a flat year, from 555 to 548, down 1%. But overall, double-digit growth, some high single-digit growth in 2016, a low 4% in 2014, but analysts are expecting 12% in 2025 and 12% in 2026. And it has tremendous growth since 2017. You can see here double-digit growth consistently over the past few years. This is why I like this company and why I purchased a few shares. But I think it's going to go lower, and I'll show you why I think that technically. But first off, this is what you want to see: earnings growth and long-term growth. And the dividend has been growing consistently with a very low payout ratio. You can see here 17% payout ratio. So this company could grow its dividends at a high double digit, 15, 18%, 20% for a few years before it gets even near 50% of the earnings. But the reason why I bought these shares of this company, you can see here, it was short in the time period to more recent years, and it's been growing at a 15.5% in earnings. You can see based on that, it's undervalued at a 13.65 earnings PE ratio. And you can see here fair value is around 15.5 or 16, and the normal multiple is at 16. And you have an earnings yield of 7.3. I like to see this as 6.5 or higher. So we got that. The dividend yield is low at only 1.3. But I'm going to go over that as well. It's almost near the 5-year average high. So those are good indicators that is a good time to be buying shares of the company. It's an S&P credit rating of A, so it's investment grade, and it has a low long-term debt to cap ratio of 35.15%. So overall, everything looks good here. I'm liking it, right? And you can see, if it revert back to a normal multiple of 16, you can have a 20% annual rate of return for the next few years. So that's outstanding. I like to see that a lot. And if we go to performance over these past years, you can see the dividend's been growing very nicely. 15% in 2023, 13% in 2022, 18%, almost 19% in 2021. So it's been growing very nicely, double digit. And again, like I mentioned, it has extremely low payout ratio of 70%. If we go by operating cash flow, again, operating cash flow 19% payout ratio. Free cash flow, you can see here 19% in free cash flow payout ratio with the dividend. So overall, the company's dividend is very safe and has plenty of room for dividend growth. So that's why I like it. And as you can see here, it's undervalued based on FastGraph. An analyst source scorecard. This company is very predictable, so I like that a lot. So it's pretty accurate that these projections are accurate. And long-term growth, they're estimating around 12% growth going forward, continued double-digit growth. And you can see here, if it to revert back to 15 PE, you could have 15% annual rate of return going forward at the current price. And if we go to a more normal multiple, when I use this, I like to look at the lowest multiple, kind of like worst case. Because if I pick the highest, for example, 16.5, look, I'm making 30%, 20% in the next few years. But I like to look at worst case here, 15-year average. So you can see here, is based on the 15-year average, the normal multiple, the current multiple, is higher than the normal 15-year average. But with that, we get a nice 11% annual rate of return. Is that good? It's not great, but it is good, right? I kind of like that worst case scenario type of deal there. And if we go to Morningstar over here, you can see Morningstar has a 3-star rating, but it's based on September 4th price of 547. So, and fair price of 550. So this is actually has not been updated. So I think if it were to update it, it'll be a 4-star buy if it were to be updated based on Morningstar fair value price. So this is why I like the company. And if we go lower here, you see some other companies that's competitors. CVS here, Cigna. I own CVS, this one here, and Cigna. So I own all 4 of these companies. Cigna Group, I own it in my Roth IRA at around I'm almost up almost 200%. I bought this one pretty long time ago. It's been a great investment there. Hopefully this one comes out the same. But overall, you can see here, if we go to CFRA has a price target of 563. So it is much better price target than the current price, which the current price was 496. If we go back, you can see here earnings are expected to be higher as well. 2024 is higher than 2023, and 2025 is higher than 2024. So that's what you want to see. Earnings continue to grow. CFRA is projecting 13% annual rate of return for the next few years, and A+ SPGMI quality ranking. And if we go to here, the fair value calculation, they have the company fairly valued, but like Warren Buffett says, he'd rather buy a great company at a fair price than a fair company at a great price. So this is kind of that deal here, and this is what makes this company a great company. You see earnings growth continue to grow. They're profitable. There's no down year in earnings. The dividend is very low payout ratio, so the dividend is very good. And if we go back here to Stinking Alpha, you can see, like I mentioned, the dividend is almost at the 5-year high. Obviously, this is COVID, where it was almost 2% at 1.92 dividend yield. I doubt we'll get that, but this 1.5 is where I'm trying to look to buy. And I tell you why here. If we go to the weekly chart, this actually broke a trend. If we go here and make a trend here, right there, you can see this trend was broken. It started here and then it created there, tested there, kind of tested there, and then now it broke. So normally what happens when a trend is broken, it gets a retest, and that's probably what we're seeing right now. It's a retest, and it's under the weekly moving average on the 50. So I'm interested in buying more shares in this area here. If we draw this here, this is where I'm interested in buying more shares. This 440, 450, and if we get here, I'm buying a lot more. Why? If we go back to fast graph, first off, it's already undervalued at the current price. And if we revert back here, we'll probably get a PE of 9 or 10 on a company that's growing double digit. Sign me up. And that's what I'm looking forward to. So right now, with the 2 shares, I wanted to get in, have my foot in the door. And now if it goes to 450 here, I'll probably buy another 2 more shares, 3 more shares, 4 more shares. Trying to get this position to maybe like 5-6 grand. Worth of shares. And now if it gets to this 430 here, this is where I'll be buying more shares, maybe make it a full position, 10-15 grand position here. But I like it a lot. You can see here it did broke that trend line, and now it's retesting. So we'll see what happens. Does it recover the trend and goes higher from there, or it looks like it's retesting and then fell down. And the interesting part is tomorrow they actually have earnings report, so we'll see how earnings happen. So I'm gonna have my buy button ready. You can see here earnings is gonna be in the morning, tomorrow, October 17th in the morning. So we'll see how it goes. You can see here today they had a pretty good day here. It jumped from 484 to 996, over $10 jump. And this is that day I mentioned that it had a pretty nasty gap down. It had a green bar here, and then it had a gap down here. But now, buyers stepped up here. Maybe they know some information based on earnings, or it's just the market maker trying to close the gap before it heads lower with the earnings report. But that's what I'm waiting for here, to see what happens with earnings. Does it gap up higher and moves higher from there? Okay, great. But I have shares and I'm participating in the company at an undervalued price. Or investors don't like what they see in the earnings and projected outlook, and it maybe drops the price around 440, and that's why I'm going to be picking up more shares. So I have no problem being red with the position I'm in currently. So right now I'm up, like I said, maybe about 1% or so, but no big deal. But you can see here on the monthly chart, again, this 430, 420 falls right in line into this 50 moving average on the monthly chart, and you can see here how it kind of respected here, respected during COVID, and I'm projecting maybe one more respect here before it runs higher. Because why would it run higher? Because earnings are expected to continue to go higher, and even if they have, maybe a 10% increase from 2024 from 2023, that's still double-digit increase, right? And stuff like that, it drops the market because the outlook, earnings are expected to drop, a few percentage, but it's still growing double-digit rate, and the dividend is well covered and is undervalued. And if that happens with the outlook with lower earnings projection, the price drops. They're just buying opportunity. So that's what you gotta look for when you're waiting for earnings play. So again, I like this company a lot. I bought the 2 shares, and with that, I'm interested in buying more shares of this company. Thank you for watching, and if you're new to the channel, make sure you hit that subscribe button if you're new to the channel, and if you like the video, make sure you hit that like button for more videos like this, and I'll see you guys in the next one. Thank you.